Everyone. Well, another session, the unit 14 of the subject management of insurance services. Today, in this unit, we will understand the concept of solvency and asset liability management, which is a very important aspect of the insurance sector as well as the entire banking industry as a whole. So, in this unit, we will understand the concept of what is solvency mean. Then we will know what is a solvency margin and what are the regulatory norms of this maintaining a solvency margin. We will understand further the concept of solvency ratio. Then we will move further to the concept of asset liability management. Finally, we will see the different regulatory provisions, and at last, we will just see an example of IRDA AI annual report for 2020-21 on the solvency and asset liability management. Now, when we talk about solvency, the term refers to the firm's ability to meet its long term financial obligations. So, the solvency of a company means the company has maybe, like, say, for example, suppose the company has raised funds by issue of debentures. So when the company is issuing debentures and raising funds from the public, so company is liable to pay to the debenture holders at a fixed period of time. Suppose maybe the debenture is issued for a period of 5 years or 10 years. So after 10 years, the company is liable to pay the principal amount what the company has borrowed from the debenture holders. So that means the company should have or make planning adequately for the amount of liquidity, the amount of money which should be available with the organization so that it can meet all these long term mandatory financial obligations. So that is what is known as solvency. Solvency ensures that a company's liabilities are paid when they become due. So you are planning from, the company is planning from beforehand the liabilities which is known to the company earlier, and that can be paid with a proper planning. So solvency, it is a state of not being in debt beyond one capacity to repay. That means the company is planning from advance the amount that has to be paid in future, so that it will not become a defaulter in future when the time comes for repayment comes. And it means possession of assets in the excess of liabilities. That means the amount of liabilities which a company has, the assets, the liquid assets should be more than that of the liabilities, so that they can pay off their liabilities on when the due when the time for the liability due payment has to be made. Then ability to pay the debts and sustain operations in the long run. So solvency means it is the ability to pay the debts which the company is liable, and so that the company will not default and can sustain in the operations of the business for a longer period of time. Now let's see why this solvency is important. Solvency of a company, this indicates the overall financial health and stability of an organization. Of course, yes, if the company has adequate amount of assets to pay off its liabilities in future, then of course we say that the company is having a sound health. That means sound financial condition. This reduces the financial failure, the risk of financial failure or default. So if you have adequate liquid assets more than that of the liabilities which is existing with the companies, then of course the risk of financial failure will be less. And the company, this solvency demonstrates the company's capacity to manage future business operations. So overall, it means that the company's solvency is the capacity of the firm to meet its obligations in longer term. So especially it is critical for insurance company. Why? Because the insurance company have to have to settle their claims which are coming in future. So that is why maintaining proper solvency is very much important. Now let us understand the concept of solvency margin. Now, what is this solvency margin? As we understood that solvency means the capacity of a company to pay off its debt which is due in future. So, what is margin? Margin, you can say it is a buffer, or it is, you can say, a point or a benchmark that the company should maintain so that it can pay its debt on time. That is known as a solvency margin. So solvency margin is the extra financial cushion an insurance company keeps. So it is, as I said, it is the benchmark, or this much amount of money has to be there with the insurance company to maintain to pay off all types of claims that are coming in future. So that means you can say that this is a safety buffer. It shows whether the company is strong enough to handle the future claims that is coming. If assets are higher than liabilities, then the company is considered finally healthy and capable of meeting its obligations. This we have just discussed in the previous slide. So companies should have assets to be higher than the liabilities, so that at times when it is coming to the part of meeting the obligations or the liabilities, the company can pay off from these assets. In insurance, liabilities mainly mean the future claim payments to the policy holders. So in insurance, as I was just discussing, that in a company, suppose the company is raising funds through debentures, by issuing debentures, but that is a case of a normal private company or listed company. Suppose I take the example of insurance company. So insurance company, when we talk about a long-term liability in future, that means the insurance company has to settle the claim payments of the different policy holders as and when it comes. So that is why they are bound to keep their assets in form of cash, bonds and other funds that will be there for their own safety measures, so that whenever the claim settlement comes, then they will be in a position to pay those claims. Now let's take an example. Suppose the insurance company has a total asset of 1000 crore, and in future it is predicted, because you can never predict how much amount of claims will come in future, but yes, you can never predict inaccurately, but yes, by seeing the different types of risks that are covered in that policies, you can make a prediction, you can access that after maybe 5 years or 10 years, what is going to be your claims that you need to settle. And from the experiences also, you will be able to assess what sort of liabilities you are going to face in future. So expected liabilities are actually the future claims which are to be settled by the insurance company. Not let us assume that the expected liabilities will be around 800 crore. So now we said the assets should be above the liabilities. So solvency margin is asset minus liability, which is 200 crore. So this 200 crore is a cushion for the insurance company. And in additional to 800 crore, if any other type of claims also come for settlement, then they will be also in a position to settle those claims, because they cannot accurately assess what is the exact amount of claims they are going to settle in future. So this 200 crore is the solvency margin, and this is an extra buffer. What this means in practical terms is that even if claims suddenly increase, so even if there is more claims beyond 800 crore, then the company still has additional funds to pay to the policyholders without collapsing financially. In management language, the solvency margin is basically the insurer's shock absorber. So this 200 crores is treated as a shock absorber. It doesn't generate profit directly, but it protects trusts, continuity, and long-term credibility of a business. So that is why solvency margin is very much important, so that you get a additional cushion beyond the entire settlements. After giving all the settlements claim, all the settlements done, also you have a buffer, so that in terms of any sort of emergencies or increase in the claims, the companies will be in a position to settle down. Now, this solvency margin, what we were talking about, this cannot be decided by the company themselves. So in India, the regulatory IRDAI, the insurance companies, they cannot decide their own safety buffer. So they cannot define their own solvency margin. So the IRDAI sets the mandatory rules to ensure insurers remain financially strong. So this solvency margin is prescribed by the IRDAI, the regulatory authority. As per the Insurance Act 1938, the section 64 VA and IRDAI regulation, every life and general insurance company must maintain a required solvency margin. So this is the guidelines which was given, and this means that the company's available capital must be higher than its projected liabilities. The most important benchmark is 150% solvency ratio. That means you have to have a above 100%. That means you suppose 100% is your liabilities that you have made. Above that, another 50% above the 100% you have to keep as a cushion. So 150% solvency ratio has been prescribed by the Insurance Act 1938. This act like a minimum financial fitness score. So this 150%, it can be beyond that, but beyond that, if you keep, maybe the cash will remain idle. But 150% solvency ratio is a minimum fitness score for any insurance company. If an insurer falls below this level, the regulator can intervene because it signals higher risk to policyholders. So if it is not 150%, if it is 120%, then what will happen? The regulator will intervene. They will ask the companies to raise the liquidity, the solvency ratio to 150%. So that means it has to be 150%. Let us take an example. If the solvency ratio, the level set by IRD is 150%, and the company's required solvency capital, their solvency capital means that the company has to repay 100 crores as in terms of claim settlement. So available solvency margin is 150 crores. So you have to have 150 crores. If the company has only 120 crores, then it is below the regulatory threshold. As I said, it has to be, so company needs to have total solvency margin of 150 crores. If the company does not have 150 crores, then the IRDAI may ask the company to infuse additional capital. That means if it is 120, you should go to 150, or they have to reduce their risk exposure. That means they have to reduce exposing their policy, the risk which are exposed in their policy, or else they have to improve their financial position. So there the intervention, if it is less than the solvency margin, then the interventions of the regulatory authorities comes into existence. Now let us see, we have already understood actually what is the main importance or need of solvency margin. Insurance companies collect premiums today, but they may have to pay the claims many years later. So as we have discussed that when the policy holders purchases the policy, they will pay premiums at regular intervals. But now they have to pay premiums, let us say for 10 years, 12 years, 20 years. So they will, the premiums are paid at intervals, but the insurance companies will settle the claims of their premium paid at a later date in after several years. So because we don't know and future is always uncertain, so the insurance companies must keep a financial buffer to handle these unexpected situations. This is where the solvency margin become very critical. It ensures that the company has enough funds even if actual claims turn out to be much higher than estimated. They should have to maintain a minimum 150% of solvency margin. So there might happen future, since future is very uncertain, there might happen that the actual solvency level might go up, or suppose there might be increase in the claims. So this buffer will definitely help them out to be safe in settling the claims. So that will directly maintain customer trust. So insurance also maintain technical provisions, which are funds kept aside specially for expected claims. So insurance can have sinking fund accounts where they can keep in some amount of money, like it is done in recurring deposits, RD. So they can keep in some funds and they can uh, for a period of time, and they can withdraw their funds at when it is required. However, real world risks like natural disasters or economic shocks can push the claims beyond the normal levels. The solvency margin acts as a second layer of protection after these provisions. So after all the provisions are made, solvency margin is a cushion or buffer which will help to keep safe at times of need. In strategic terms, it protects against three things. One is it will protect the company to be financially stable, it will protect the company to have customer trust and continuity of operations. Now let us move on to the next concept. This concept is also linked with the solvency margin. The next concept is solvency ratio. So solvency margin is linked with the solvency ratio. How? Solvency ratio is a ratio which measures an insurer's ability to meet the short-term and long-term financial obligations. So same as the definition we had learned in the first slide, what do you mean by solvency? So it will tell how far the company is capable in order to meet the short-term and long-term liability. It reflects whether the company's cash flow and capital, the cash which is existing with the company and the capital, are sufficient to absorb the claims risk. So what are the claims which are going to come in future? Whether the company cash flow and capital are adequate enough to absorb the claims which they are going to receive in future, claim settlement by the policyholder. A premium return is better indicator than the total sum assured, as it links directly to claim likelihood. So every individual policy will have two things. One is the premium which is paid by the policy holder, and another one is the sum assured which is mentioned in the policy. So now when a person is paying the premium at regular intervals without any default, then the company should see those clients, because by seeing the regular premium payer clients, this will become a better indicator of assessing what claims are likely to be aroused in future, rather than seeing the sum assured insured in different policies and then assessing what is going to be the claim settled in future. So premium amount that is paid at regular intervals, that has to be considered while calculating what is the amount of sum assured, which is amount of claims to be settled, which is likely to come up in future. In insurance, solvency shows the size of capital relative to the risks undertaken. So solvency will show that what amount of risk have the company undertaken and what is the amount of capital the company has taken from the market. So that will relate to the risks that is being amounted by the insurance company. Now, let us see how this calculation of solvency ratio is taken out by IRDAI. Insurance must calculate the solvency margin. Solvency margin, as we have already discussed here, solvency margin is, you have 150 crores and here it is 100 crores. Here I have the solvency margin is calculated as assets minus liabilities. What assets the company has minus the liabilities which the company is now due to be paid. So the process involves, first is valuation of assets. That means approved investments and securities. How much they have invested in bonds, government bonds and securities, that they have to value. Certain items like unrealized advances, deferred expenses, preliminary expenses are assigned zero value. So they have not assigned any value. They cannot be considered. And a detailed determination of the liabilities. Liabilities means in terms of claims to be settled. So then you got your valuation of assets in terms of cash or approved investments in securities, and minus the liabilities that you are assessing from the, by forecasting the amount of claims to be settled in future. So that differentiation assets minus liabilities will give you the solvency margin. Now, then how do we calculate the solvency ratio? So it is available solvency margin minus the required solvency margin will give you the solvency ratio. Now let us quickly see what are the factors affecting the solvency margin or ratio, solvency ratio as well as solvency margin. First factor is capital gearing. Capital gearing is nothing but the efficient use of capital which improves the solvency. Misuse leads to poor returns and strain. So here capital gearing means, suppose you are investing, you have to know where you are investing it efficiently in bonds, so that at times you require, you can be able to withdraw the funds from there. So that is known as capital gearing. So efficiently handling the capital, investing the capital in appropriate assets, so that it can, at times when you require, you can efficiently withdraw those funds at a higher percentage and you can give back your dues. So that is why it is known as capital gearing. It is efficient use of capital which improves the solvency. Higher solvency builds investors and regulator confidence. Low solvency invites IRDAI restrictions. As we have already seen that if the solvency is 150%, then it will sustain the trust of the market, the policy holders, the clients, the customers and the regulators. But if the solvency is low, then of course IRDAI or the regulatory authorities, they will intervene and ask you to increase the solvency margin. Then Asset liability mismatch is another factor. If asset liability mismatch match is there, then obviously there will be liquidity risk. That means you will not be able to repay the liabilities as it comes. So there has to be, assets has to be greater than the liability. Underwriting and pricing risk, inadequate premium and poor risk selection weaken the solvency over time. So if the premiums are not inadequate premium, that means when you are pricing the insurance policy, so if you are not fixing the premiums at appropriate rates, then obviously that when the claims are settled in terms of sum assured. So if the pricing is not done properly, then obviously when you are settling down your claims, there the financial strength of the company, of the insurance company, will be reduced. Then it sometimes catastrophic risks are there, like natural calamities. This can also sharply reduce the solvency if it is insured. If you don't maintain a solvency margin adequately, then all these things will have an impact on the solvency margin. So what is the indicator rule then? If the claims ratio is greater than 100%, suppose claims ratio is 100%, cash outflow exceeds premium inflow, cash outflow will exceeds the premium inflow, then financial instability risk is there. Cash outflow exceeds the premium inflow, then the financial instability will incur. Now let us move on to the concept. This is also linked with the solvency ratio and the solvency margin. The next concept is asset and liability management. As we have understood that a proper balance between the assets and liabilities needs to be there, maintained by the company, so that they can pay off their liabilities at appropriate time. So asset liability management is a process of managing assets and cash flows to ensure a firm can meet its future liabilities on time. So insurance companies, when they are pulling funds from the different policy holders, so in that case, they are making a pool of funds and investing in different securities, government bonds and securities. So they should ensure that while they're managing these assets can be easily converted into liquid cash at times when they are requiring to settle the claims. So asset liability management evaluates whether assets are sufficient to cover the liabilities arising from existing business based on valuation at a given date. Asset liability management focuses on time and matching the cash flows. Timing as well as on matching the cash flows. Cash flows, suppose today you have to see as on date what is the claims that has to be settled and what are the assets which are there with the company. Assets has to be more than the liabilities which has to be settled by the company, insurance company, as on today. So the purpose of ALM is to reduce risk of default or delayed payment of liabilities. So in order to reduce the risk of being defaulted without payment of the liabilities, liability management balancing has to be there. The purpose of ALM is to improve the profitability through efficient asset liability matching. Commonly applied, this concept is commonly applied not only to the insurance companies, but also these are applied to bank, loan portfolios and pension funds. So all these portfolios need to maintain a proper asset liability management, wherein if you are liable to pay something in future, if you are to your creditors, then of course asset liability management is a must. So core functions of the asset liability management are liquidity management risk, market risk management, trading risk management, funding and capital planning, and profit planning and growth projection. So all these things are very well required to be managed when we consider the asset and liability management. Now, the IRDA Act 1999 also has laid down the framework for asset and liability management. The issued order, Section 14 of IRDA Act 1999, and the objective of this order was to regulate, promote, and ensure orderly growth of insurance and reassurance business. So, the main objective of this was to encourage, promote, and adequately regulate the growth of the insurance and the reinsurance business in a proper track. So asset and liability management ensures that there is a proper match or coordination between the assets and liabilities. The ability to meet the future cash flow and capital requirements. And it is also this ALM framework, asset liability management framework, is also applicable to all the life and non-life insurance companies. That means it is applicable for life insurance as well as general insurance companies. So ALM is a board approved policy, and it is aligned with the risk tolerance, solvency position, and liquidity requirements. Risk tolerance of a particular organization, solvency position of that organization. We already talked about solvency position. What is the assets to liability position, and the liquidity requirements. So how much amount of liquid assets has to be there with the organization in order to pay off the liabilities. So as per the ALM policy in the IRDA guidelines, there are few key requirements of the different of the insurance companies to maintain a match between the asset and liability management. Insurance must formulate an ALM policy approved by the board. So, insurance companies have to make a asset liability management board, and the policy has to be policy of ALM policy has to be approved by the board. So, then the policy has to be submitted to the IRDAI within 90 days. So this is a mandate which every company has to do. Now, asset liability management framework should help insurers to identify and understand the risk which they are going to foresee in future, design the asset liability management strategies to manage these type of risk which they will be incurring in future, and apply suitable techniques based on business nature and local market conditions. So ALM will help them to work in a more organized framework so that they can manage their asset as well as liabilities. They will not be defaulter. Major risks which are covered under the ALM are market risk. Of course, as I said that there might be certain risks which are unforeseen in future, which might increase the level of claim settlement. So, risk like interest rate risk, equity, currency, credit spread, this cannot be avoided. So, market risk cannot be avoided. Another type of risk which is covered under the asset liability management is underwriting risk. Now, underwriting risk is underwriting risk is on the part of the insurance company. So that also will be coming under this, because the more you underwrite a policy, the amount or sum assured, that means the company is liable to pay that much amount in future if it is claimed. So that is again a risk which is covered under the asset liability management. Liquidity risk, the company should have the amount of liquid assets which they can easily convert into cash, readily convertible into cash, and they'll be in a position to pay off their debts. The quarterly and annual ALM reporting is mandatory through the prescribed format. So every insurance company has to prepare a report at regular intervals, quarterly and annually. The asset liability management report has to be made through mandatory formats, prescribed formats, which is as per the IRDA guidelines and is to be submitted. Stress testing, this is one format of the IRDA regulation. Now, stress testing is actually the IRDAI authorities are testing the capability of the company so that they are in a sound position to pay off their liabilities and as and when it comes. So that is known as stress testing. So stress testing assesses the insurer's vulnerability under the adverse scenarios. There might be adverse scenarios like in future you have predicted a particular amount of claims to be settled, but the claims settlement have increased. The claims that has been given by the policy holders have increased. So now you have predicted something, but you have to pay now more because the claims are more. So that is what is known as stress testing. So it helps to evaluate the financial soundness and the risk absorption capacity. So this type of stress testing helps the regulatory authority to evaluate the financial soundness or stability of the company and how far, if such type of stress is happening in future, how far they're capable of absorbing it. So it is mandatory. This type of stress testing is mandatory for both life insurance companies and general insurance companies. It covers shocks such as fall in equity market, interest rate movements, change in mortality or morbidity, expenses, lapses, and claims. So all these are factors which will lead to increase the number of claims by the policyholders. So when claims are increased, obviously your predicted claims and increased in claims, there will be a huge gap. So now the company has to have that much amount of margin so that if there is a bit of gap between the actual and the predicted, they'll be able to pay those amount of claims which have been arised. Insurers must submit stress test results in prescribed format. So there is prescribed formats which are being given by IRDA, and they have to submit that, conduct regular review of the outcomes of the stress results, and take corrective actions when it is required. So for this conducting the stress test, they are appointed actuaries who follow the professional actuarial standards to conduct this test. Now, as per IRDA Asset Liability and Solvency Margin Regulation 2016, we will just quickly look into what are the regulations as per the IRDA 2016 regulation. The 2016 regulation, the first, it was issued under IRDA Act 1999 and the Insurance Act 1938, and it was applicable to all life insurance insurers in India. Now then it became effective from this 2016 regulation. It became effective from 1st April 2016. Now objective of this regulation was to standardize the valuation of assets and liabilities. So they have to, as we just discussed, there are some assets where the values are zero, and there are some assets which you need to assess, like the bonds where you have invested. So their objective was to standardize the valuation of assets and liabilities, uniform determination of the solvency margin. They need to determine the solvency margin which is to be maintained by the insurance companies and strengthen the financial stability and finance policyholders protection. So again, this 2016 regulation was replaced by IRDA regulation 2000. This was asset liability and solvency margin of insurers. Now, what were the key provisions in this regulations? Valuation of assets. It is in Schedule 1. You can see here certain assets are assigned zero value, such as unrealized premium and sundry debts. Unrealized premiums, where the person has continued paying premium but has stopped after maybe 2 or 3 premiums that the person has stopped paying the premium. So it is unrealized premium and the sundry debts, advances or receivables of the unrealizable nature, which are not going to realize in future. Furnitures, pictures and stationery, these are also not coming under the assets valuation. Deferred expenses and fictitious assets, outstanding reinsurance balances, leasehold improvements and inadmissible assets. All these are being assigned zero value as per the valuation of assets. The remaining assets are valued as per the IRDA prescribed norms. As I said, the amount which you have invested in different government bonds and securities will be valued at the present market price. Now, valuation of liabilities is in Schedule 2. So, liabilities are determined through actual valuation. So, actual market valuation. Focus on mathematical reserves for each policy. It is based on the expected future premiums and benefits. How much premiums, if you see continued premiums, then you can very well assess what is going to be the optimum claims that has to be settled. The mortality, morbidity, expenses and lapses, and adequate margin for adverse deviation. Now, mathematical reserve, solvency and authority powers. So here we have discussed about what is this mathematical reserves of each policy, how the liabilities are calculated. So mathematical reserves it is calculated mainly using gross premium valuation method. Gross premium is total amount of premium that you are receiving. That is the gross premium. As I said here, the policy holders who have paid for some period of time and those who have discontinued will not be included in this category. So it is the total amount of premium valuation, which is known as mathematical reserves calculation. Negative reserves allowed only as per regulations. Options, guarantees, bonus, surrenders values are also considered while you are calculating your final liability. Solvency margin, this is prepared as per Schedule 3. Solvency margin is, as initially we have discussed, it is 150%. Solvency margin ensures insurer can absorb adverse financial shocks. If you have more than 150%, if you have 150% solvency margin, then obviously additional financial shocks also the company can absorb. Role of appointed actuary. So here we have discussed that the calculation of doing a stress test calculation of the assets and liability will be done by an appointed actuary who certifies the asset valuation, who evaluates the asset, like he is like an auditor who certifies the asset valuation and liabilities and the solvency margin. So the appointed actuary must follow actuarial practice standards. The powers of IRDAI is to issue certifications and guidelines, to call for additional information and ensure regulatory compliance and financial soundness. Now, Schedule 3, we were just talking about Schedule 3 gives the solvency margin. So, Schedule 3 solvency margin of life insurance business. Now, this is applicable only for life insurance business. Available solvency margin. What is available solvency margin? It is the excess of value of assets over the insurance liabilities, after considering policyholders and shareholders funds. So liabilities includes policyholders funds and the shareholders funds also. It is not that you are only paying to the policyholders in forms of claim settlement. You are also paying to the shareholders, because you are liable to pay the shareholders from your from the profit that you get. So it is excess of value of the assets over the insurance liabilities. Required solvency margin is minimum solvency margin prescribed by IRDAI regulation, which is 150%. Solvency ratio, we have understood, available solvency margin divided by required solvency margin will give you the solvency ratio. Every life insurance must maintain available solvency margin should be greater than or equal to the required solvency margin at all the times. That means requirement, it should be above the required solvency margin. If requirement is 100, then available solvency margin should be 150, so that a cushion of 50% is always there. Falling below 100% of the required solvency margin attracts regulatory action under the Insurance Act. So whenever the required solvency margin falls below 100%, then the interventions of the regulatory authorities comes into picture. Now let us move on to the controlled level of solvency and its determination, how it is determined. So control level of solvency, as I said, it is specified by IRDAI at a rate of 150%. If solvency level falls below the control level, IRDAI may initiate corrective and supervisory measures. So requirement is 100 crores, you should have 150 crores. If it is below 150 crores, it is above 100 crores. But if your solvency margin is 150 30 crores, let us assume it is below 150 crores, then the solvency falls below the control level. And in that case, the IRDAI has to initiate corrective action and supervisory measures so that the company can come up to the required solvency ratio of 150%. Insurer must define and report the required solvency margin, the available solvency margin, and the solvency ratio. Divide available solvency divided by the required solvency will give you the solvency ratio. Reporting can be done through prescribed actuarial report and abstract formats. Now, solvency margin for general insurance 2016, as per 2016 regulations, the key requirements are to prepare admissible assets. There is a form, this is the form number, the form name, IRDAI GITA, general insurance. So here, prepare admissible assets. First you have to put your assets there, determine the liabilities. Here there is another form, and calculate the solvency margin. This is also different form. So definitions include the key reserves, claim reserves, unearned premium reserve, and premium deficiency reserve. For business outside India, additional reserves required if solvency is lower than Indian norms. If suppose the business is outside India, then there might be a requirement of more solvency margin than the minimal Indian norms. So it can go above 150%. So IRDAI may require personal visit of appointed actuary for the clarification of the review. So at times the appointed actuary by the company can go and visit IRDAI whenever there is a review. Reappeal and savings. Reappeal, authority power and asset valuation. IRDAI assets, liability and solvency margin of insurers, which is regulations 2000, was reappealed. Actions done earlier remained valid under the old regulations. So power of IRDAI was IRDAI may issue clarifications or guidelines to remove difficulties in interpretations. So here, when it was reappealed, there were again the Schedule 1 valuation of assets. The following assets were assigned 0 values: unrealized premium and sundry debts, advances or receivables of unrealized nature, furniture, fixtures and stationeries, deferred expenses, fictitious assets, reinsurance balances outstanding beyond prescribed days, and leasehold improvements and inadmissible assets. Other assets valued as per IRDAI norms and accounting regulations. Other assets are valued. Initially, it was only as per IRDAI norms. Now, then, after this, it became the other assets will be valued as per IRDAI norms and the accounting regulations. Now, Schedule 2 says the Schedule 1 tells about the valuation of assets and Schedule 2 tells about the determination of the liabilities. Now, liability is calculated line wise on the valuation date. So, on that particular date only the liabilities will be calculated. And what does the liability include? The liability includes unearned premium reserves, and this has to be certified by the chief finance officer and the statutory auditor appointed. So this will be included under liability. Premium deficiency reserve, which is actually determined by the appointed actuary. Unexpired risk reserve, which is this plus this unearned premium reserve plus the premium deficiency reserve, and the claims that have been reported by the different policy holders. So this entire thing, the UPR, DPR and the claims reserves, URR and the claims reserve will overall define the total number of liabilities which the general insurance companies need to pay. Now, Schedule 3 tells about the solvency margin. That is same there we had seen in case of life insurance. So here available solvency margin is the assets minus the liabilities, and solvency ratio is the available solvency margin divided by the required solvency margin will give you the solvency ratio. So the insurers must maintain the available solvency margin should be greater than the required solvency margin, and the control level of solvency, it may be in case of the normal life insurance company or a general insurance company. In both the cases, as per IRDAI, the control level of solvency is always 150%. I will just in this like here in 2016 regulation, the schedule was there for the life insurance companies. So here also we have seen the valuation of assets as per Schedule 1. We have valuation of asset, the same has been fixed for the general insurance companies also. Outstanding reinsurance balances, everything is same. Similar in case of valuation of liabilities also. Here, liabilities are determined through actual policy, same thing. But in case of general insurance that we see, this is as per schedule 3. It is in case of life insurance. Here, if it falls below the 100% of RSM, the required solvency ratio, then the regulatory authority will come into action. But here also the controlled solvency ratio is 150%. And but this 2016 solvency margin, this is for general insurance. So here it is there, here they have a bit different formats as in case of a life insurance. So here most important is that these how are you going to calculate the liabilities by using this. Assets are same as that of the life insurance, general insurance same, and here the liabilities are, this is different, where you are defining the unearned premium reserve, premium deficiency reserve, and all these things. So there is minor changes in, if we see, in case of life insurance determination of asset and liability, and general insurance determination of asset and liability. Then now, finally, this is just a snapshot of the how the reporting of the solvency ratio has been done by IRDAI, is done by IRDAI. There is an annual report which is presented, and this is a snapshot of 2020-21. So life insurers, as per the report, all 24 life insurers complied with the solvency ratio of 1:5. That means 150% solvency ratio was maintained by all the life insurance companies. But when it comes to general insurance, let us see, 26 of the 27 private general insurance companies met the solvency requirement. That means only one company could not comply to the solvency ratio. Public sector insurers showed stress. We were talking about stress testing. They showed stress due to COVID-19 liabilities with solvency ratios below 101.5. That means here the public sector companies showed stress and they were below 150% of the solvency ratio. Standalone health insurers largely maintained the required solvency. And for reinsurance companies, GIC reinsurance company reported solvency ratio of 1.74. So it is more than that. Foreign insurance branches in India also reported a solvency above the minimum norms. Minimum norm is 1.5. That means 150%. So they have maintained, the GIC reinsurance company and the foreign reinsurance branches, they have maintained, and it is advisable when there are foreign reinsurance branches, it is advisable that you should go beyond the solvency ratio which is prescribed, and they were all financially stable. So only the issue was here in this report, it can be very well known which sector or which companies or how many companies actually defaulted in their maintaining their solvency ratio. So now we come to the end of this unit. Thank you.